Welcome back to the Startup Junction, and specifically to our segment, the FLUX Decoded. Our mission today is not just to report a piece of news. It's to decode one of the most significant private funding events in history, and, more importantly, to understand the fundamental strategic pivot that's happening behind the headlines. We are, of course, talking about Databricks.
Of course.
They just closed a staggering $4 billion Series L round.
I mean, it's a number that's hard to even wrap your head around.
It is, and this cash infusion catapulted their valuation to a breathtaking $134 billion.
Right.
Let's just put that in context for a moment. This makes them one of the most valuable private tech companies out there, but they're already operating at the scale of a public giant. I mean, $4.8 billion in annual recurring revenue.
Exactly. So the real question isn't just how big are they?
Right.
It's why the market is assigning this specific massive value to their position right now.
Yes, why them?
What's truly fascinating here, and I think this is the core of it, is that this valuation is a critical turning point. It's the definitive financial signal marking the end of the, let's call it the model hype era.
The era where everyone was just obsessed with the smartest, flashiest large language model.
Precisely. And it marks the aggressive, full-throttle beginning of the infrastructure reality era. For the last couple of years, all the excitement was focused on who could build the biggest LLM, the best chatbot. The most powerful general intelligence like OpenAI. But the money, the defensible value, is rapidly shifting away from those model builders. It's moving decisively toward the companies that own, organize, and activate the massive amounts of enterprise data those models need to actually be useful.
So Databricks is no longer just a storage locker.
Oh, not at all. It's completed its transition. It's no longer just a high-end storage locker for data. It is now viewed as the indispensable engine room for the next generation of AI agents.
Okay, let's unpack this. I want to focus on the three major strategic shifts that are driving this colossal, $134 billion valuation. Wait, start with the product side. Shift one, the undeniable rise of agentic infrastructure.
Yeah.
The key drivers that Databricks highlighted aren't their original data warehousing products. It's their AI-specific product lines, AgentBricks and Lakebase.
And that business line is growing so rapidly. It has already crossed $1 billion in annual recurring revenue.
Wow. And its growth rate is significantly outpacing their traditional revenue streams. So it sounds technical, but what is the real-world consequence of this agentic infrastructure taking off so fast?
The consequence is that companies are demanding utility, not novelty. They're finally moving past the simple surface-level generative apps like, tell me about this document or chat with PDF.
The party tricks.
The party trips, exactly. They are actively building autonomous AI agents. We're talking about systems designed to run complex workflows, manage inventory, execute financial transactions, automate entire business processes.
All based on secure, proprietary corporate data.
That's the critical part. To do this successfully, the agent cannot tolerate hallucination. It just can't. And for an agent to perform a complex action accurately and securely, it needs real-time, instantaneous access to that proprietary corporate memory.
And this is where Databricks comes in.
This is where Databricks provides the deep, specific technical advantage. Their Lakehouse architecture, combined with tools like Lakebase, they've successfully positioned themselves as the trusted, high-performance platform where these agents can, live, reason, and access secure data without risking corporate leakage or factual errors.
So they're basically the mandated safe environment for AI to actually do things at scale.
That's a perfect way to put it.
That distinction, the move from passive chat to active, reliable workflow execution is critical. But hold on, why can't a legacy data warehouse or even a traditional data lake just bolt on these features?
Right.
I mean, what makes Databricks organic development so much better than an acquisition strategy that someone like Snowflake might pursue?
It's about the architecture being unified from the ground up. Legacy systems require these massive, costly, complex ETL pipelines to move data between the warehouse and the AI lab.
The extract, transform, load process.
Yep. Databricks just eliminated that friction by making the Lakehouse, where all data types reside, the single source of truth. It's not just a feature you bolt on. It's a foundational structural advantage. It allows them to accelerate their AI product development way faster than platforms that are still struggling with those old two-tier data architectures.
Okay, so this is where the strategic maneuvering gets deeply interesting. Shift number two, the private IPO phenomenon. A $4 billion raise when you're already sitting at a $134 billion valuation. It feels like overkill. What are they truly scared of that requires that much capital?
This is a war chest. Plain and simple.
A war chest.
It is a private IPO that serves a very specific competitive purpose. By securing this colossal amount of funding, I mean, $4 billion is often larger than an actual IPO for many established companies, they gain the financial muscle and credibility of a public company.
Without the headaches.
Exactly, without having to endure the regulatory headaches or, crucially, the often short-sighted quarterly scrutiny of the stock market. This cash lets them pursue a really aggressive competitive agenda. They avoid the whole tedious S-1 filing process, which often forces companies to reveal their strategy prematurely.
Right.
Instead, they can burn capital rapidly on R&D, pursue aggressive talent acquisition, and, most importantly, finance strategic acquisitions, particularly in critical new areas like serverless compute. Their clear objective is to aggressively kill off competitors like Snowflake and establish overwhelming market dominance before they ever have to ring the opening bell on Wall Street.
So it's an infrastructure land grab.
Funded directly by the deepest pockets in finance.
So avoiding the red tape lets them be hyper-aggressive, waging infrastructure warfare, essentially. But is there a hidden price to this for the company itself?
Absolutely. The main pressure point shifts to employee liquidity. Your employees, they're holding stock options they want to pay off.
Of course.
So this $4 billion raise provides partial liquidity for existing shareholders and employees without forcing the company to go public. It buys them several more years of runway to maximize their valuation and make sure market conditions are perfect for an IPO whenever they decide to pull that trigger.
So they're sacrificing near-term liquidity for long-term control.
Maximal control and market leverage, yeah.
That brings us to shift number 3. The convergence of data and intelligence. We've had these silos for decades, right? The data warehouse over here, the AI lab over there. What proves that distinction is finally truly obsolete.
Databricks' sustained high growth over 55% year over year is the empirical proof that the old distinction is dead. The winner is the data intelligence platform. This means a unified system where your traditional SQL queries, your data governance rules, and your large language models all interact seamlessly on the exact same data, the same context.
Without needing to move it or copy it between tools?
No more moving, no more copying.
But isn't it technically simpler for a chief data officer to just keep specialized tools for specialized jobs? Why put everything in one basket?
Because keeping them separate creates a governance nightmare and a massive maintenance cost. A unified platform eliminates the need for those complex and brittle ETL pipelines, which are the main point of failure and cost. More importantly, it enforces a single security and governance layer across all data types, structured, unstructured, streaming. And that unified context is what allows an AI agent to reason accurately. If the model is referencing data with different security policies or different degrees of freshness, the output is useless, or worse, dangerous.
The platform that guarantees unified context wins.
It's that simple.
Okay, let's ground these complex shifts for you. These concepts can be pretty dense, so we need some mental models that'll stick. We've got 2 powerful metaphors to explain why the market is treating Databricks like a trillion-dollar company in waiting.
Absolutely. The first metaphor really addresses the ultimate question of AI value accrual. Where does the money end up? So think of the AI revolution like a gold rush. Or maybe more fittingly, like building a massive glittering new city in the middle of a remote desert.
Okay, a new city in the desert. The LLM builders, OpenAI, Anthropic, they are the flashy architects, right? Designing the tallest skyscrapers, getting all the media attention.
Exactly. They get all the initial hype.
All of it.
But Databricks is the water utility company.
Okay.
No matter how beautiful or futuristic that skyscraper is, it is immediately uninhabitable without plumbing, without water, without a sewage system.
It's useless.
Completely. Databricks controls the pipes, the critical infrastructure, and the water, which is the proprietary clean data that keeps the entire city alive and functioning. Architects come and go, new models get released every quarter, and commoditize fast.
But the water utility is a monopoly forever. That's the sticky, reliable revenue that supports everything else.
Precisely. The second metaphor helps explain the actual transition in how we use data. Let's look at the shift from the library to the librarian.
Okay, so previously, data storage was like a massive passive library. That's the old data lakehouse model. It had rows and rows of books, your data, and if you wanted an answer, you had to hire these highly paid data engineers to search and clean and organize the books yourself just to find something. You were doing like 80% of the work.
Oh, I remember that period well. 5 years ago, building a data pipeline was 80% cleaning and moving data, and maybe 20% actual analysis. The new data intelligence platform model changes that ratio entirely. It's like hiring a genius librarian who has read every single book in the building and internalized every single data point.
So you don't search for a book, you don't write code to join tables.
You just ask the librarian a complex synthetic question, and they instantaneously synthesize the answer from 1,000 different pages and different data formats. That's the core difference between a passive database that just stores things and an active data intelligence platform that reasons and acts.
If we connect this to the bigger picture, this $134 billion valuation for Databricks, it fundamentally changes the entire tech landscape. It signals the definitive shift in the meta-narrative.
Yeah, the major shift we're witnessing is from generative AI, which, mostly created text and images, to agentic AI.
AI that executes complex, critical workflows. And what's the central conflict that's driving all this infrastructure spending? Because that's what the $4 billion is really about.
The conflict is the painful realization that usefulness requires data access. In the hype cycle of 2024, everyone built chatbots. In 2025, companies realized chatbots are effectively useless for driving real business value unless they have live, current, structured access to the entire corporate data memory.
And Databricks holds the keys to that kingdom.
They hold the keys to the data that these agents need to do their jobs. An agent is just a chatbot that can act, but it can only act intelligently if it knows what to act upon.
Which is the context provided by secure, clean data.
Exactly.
Okay, let's briefly check in on the big four players who are maneuvering around this new reality. How are the big model builders reacting?
They are reacting with a mixture of, I'd say, fear and aggressive partnering. OpenAI, the incumbent, is under massive pressure from model commoditization. So they're trying to shift to being an operating system for agents with their Agent Swarm APIs. But here's the critical point. They need Databricks customers to plug their proprietary data into those APIs. Otherwise, their OS is just an empty shell. They're forced into a dependency.
Then you have Google, the sleeping giant.
Google is fighting back by leveraging their own native data gravity. They launched their anti-gravity platform for building agents, which makes them a clear frenemy to Databricks. They compete fiercely for the data that already lives within Google Cloud.
Right, they want you to stay in their ecosystem.
Of course. Then there's Anthropic, the enterprise darling.
With Claude 4.5.
Right. Their computer use capability is one of the most powerful drivers for these agentic workflows. But to ensure an agent controlling a live enterprise system is safe, they have to have verifiable, accurate data context. This drives them to partner heavily with secure data platforms like Databricks.
And finally, Meta, the open source king with Llama 4.
Meta is actively and successfully commoditizing the model itself. By making the raw intelligence free, they completely force the value to shift entirely to the data and the platform that houses it.
Which directly benefits Databricks.
Directly. This whole analysis leads us back to the core hypothesis supported by that huge valuation. The next $1 trillion of value in AI won't go to the company that makes the smartest model. That intelligence is becoming a commodity.
The reality check is that the defensible value will go to the company that builds the crucial bridge. Databricks is that bridge. Without it, the smartest model in the world is stranded on a cliff with nothing to eat. Intelligence without context is just expensive noise. So what does this all mean for you? Whether you're a founder deciding where to put your limited engineering resources or an investor deciding where to place capital, we've distilled this $134 billion signal down to two critical takeaways. First, the audience takeaway for founders. I mean, the message seems to be data, 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 but what's the actionable difference here?
The difference is passive versus active. Stop building thin wrappers around ChatGPT.
Those are the vanishing application layers.
Right. The 134B signal is clear. Value comes from proprietary data integration that enables action. Founders have to focus on building tools that help companies clean, organize, govern, and activate their messy data.
Not just tools that generate text.
Exactly. Transform it from passive storage into an active, context-rich environment.
That brings us to our synthesis for founders. Don't build a better model. Build a better memory.
And for investors, the audience takeaway for investors is just as direct. Look for the unsexy middle layer. The infrastructure that connects raw, messy enterprise data to complex AI models is where the sticky, defensible, utility-like revenue lives.
Meaning if a startup claims to be an AI company but doesn't have a robust, unified data strategy.
It is essentially a house of cards built on a competitor's database.
So our synthesis for investors. The application layer is thinning. Watch for the infrastructure layer consolidating. If Databricks is valued at 134B, it means the market believes the container for intelligence is inherently more valuable and defensible than the intelligence itself.
And that brings us to our final thought for you to mull over. The rise in valuation of Databricks proves a fundamental truth about this new era. In the age of AI, data gravity is the only moat that matters. The models will become commoditized, but your corporate memory and the system that houses it is priceless and impossible to replicate.
That's the deepest dive into the infrastructure reality we're seeing right now. Thanks for joining us for the FLUX Decoded. We'll catch you next time.